much. What's remarkable about all this human being crushed right now to get out and just have some fun is the fact that we're going to put up with an awful lot, you know, how it is up in the skies these days, how it is in the highways these days, and you're paying more for the privilege, more for those airline tickets, more for gasoline, more for most everything, despite the 16 cents you might be saving on your barbecue for the 4th. I want to get into that and the remarkable nature of this with Francis Newton-Stacy of Optimum Capital. We got Michelle Schneider here, Managing Director of the Market Gauge Group, and David Sacco, Economic Practitioner, University of New Haven. Professor, ending with you, I want to begin with you. Our resilience in the face of all of this, to pay more, to put up with more, because we just are so eager to break out of our seclusion. What do you think?
Absolutely, Neil. I mean, demand has increased faster than anyone expected during the height of the pandemic, and that's a good thing. The downside of that is when demand goes up, prices go up. And then as prices go up, that helps us reallocate resources more efficiently. And ultimately, that price cycle will work itself through and things will revert back to normal. But in general, it's a good sign because it means that demand is coming back. And I think that's going to help us, really recover from the pandemic crisis.
You know, Michelle, I don't like to get too sidetracked in the markets, but they were hitting records this week. The Dow and the NASDAQ and the S&P continued to advance. The S&P and the NASDAQ at all-time highs. And I'm just wondering, is that the market's way of saying it's not worried about inflation? Are you worried about inflation?
Well, to answer the first question, the market is definitely not worried as much as they probably should be about inflation. And there's some reasons why. If you look at what's happening in the bond buying program, with all the talk, it's still robust by the Federal Reserve. If you look at the yields, they're still low. And I do believe that whether or not this inflation is transitory or not, we're still in this really interesting cycle where commodities compared to equities is still very close to historic lows. So just from a cyclical standpoint, the potential for very high inflation is there, whether it happens the next 3 months, 6 months, or in a year from now. So I think what the market is doing, though, is having somewhat of a divide, and that's really important to note. Yes, the S&P 500 is making new highs, and the NASDAQ, and a lot of these mega cap stocks. But if you look at some of the other sectors, they're not quite there yet, and they could be a little bit ahead of the game in terms of transmitting this warning, like some of the financials, for example, and the transportation stocks, for example. So you got to watch this diversion and see what happens over the next couple of weeks.
Got it. You're an encyclopedia. But just to remind, when you talk about bond buying, the Federal Reserve has been, scarfing up all the Treasury notes and bonds, mortgage-backed securities, municipal bonds, corporate bonds they could to forcibly keep rates down. They're unwinding that, or they're supposed to be thinking about unwinding that right now, and that the economy's ready for it. But that's the big gazillion-dollar question, right, Francis? I mean, the Federal Reserve can respond to these inflationary pressures by slowing that buying down or reversing it, or raising interest rates. It doesn't seem like either is imminent. Certainly a hike in rates, but should it be?
Well, they're definitely not going to raise interest rates until they stop buying bonds, because it's kind of like pressing on the gas and the brakes at the same time.
Right, exactly.
And I agree with what Michelle said, but take heart. There are 5 things that got us to these record highs in the market. That's accelerating inflation, accelerating corporate profits, historical fiscal stimulus, and historical monetary stimulus. And with the exception of the Fed, the other 4 are softening. Early indicators, because of course markets like to price things in really far in advance. Remember, by the time those economic data prints come out, markets are pricing in what's next. Markets started buying inflation and the reopening in November. So lumber just sold off 40%. There is enthusiasm buying, 20-year bonds, and the dollar has had a reversal. So there are some traders that think that inflation is indeed transitory. And if those 4 things start breaking down, 4 out of the 5, you can see that that could be true.
All right, well, all we know, Professor, for the time being, is that even with these price pressures, people are buying. There are confidence surveys that were out in the past week that the most robust they've been in many, many years. People about their own financial fortune are more upbeat than they've been in many, many years. Is that justified? Do you see this as something that has some sticking power to it? Not the price pressure, just the strong economy.
Absolutely, Neil. I mean, we saw a record drop in demand a year ago, and then it popped up just as quickly. That seems relatively sustainable. A lot of it is related to government policies and the Fed easing, as the other guests have mentioned. One thing I would note about the Fed is while it was a subtle change 2 weeks ago, they did sort of change their forecast from zero rates until 2023 to late until 2022. So that tells you that the Fed has inflation and is starting to talk about inflation again. And I think the markets will react to that, right? What the markets care about is the Fed monitoring the situation and what are they doing about it? And I think that was a signal what we saw 2 weeks ago. And it wouldn't shock me if the Fed changes their guidance again slowly over the next few months. They don't want to scare the markets, but I think they want to let the markets know that it's on the horizon and they see it coming.
All right, we don't have much more time, but I'll ask a very simple question then. Are we in for 70s type inflationary spiral? I don't see it myself. Michelle, what about you?
Well, the oil really drove the start of the inflation in the mid-70s, and some of the soft commodities followed in kind, especially sugar, which of course is used for ethanol. And then it was a few years later that we started to see the big rally in gold and silver. So with that
So you
said,
don't see it. Bottom line, you don't see it. I mean, I'm jumping on you. Francis, do you see it?
No, I know you're traumatized by your first mortgage, and I fully understand that, but I don't see it. And the reason I don't see it, record amount of debt service, and debt service is going to weigh on those inflationary numbers.
Guys, sorry to be so rude, but thank you very much. She was referring, of course, to the story I might have mentioned once or twice. My wife and I, on our first mortgage, we were paying at 13.5%. I think what they're saying is it could be a hell of a lot worse, and it's not after this.